Welcome, everybody. Thank you for joining us on this Tuesday afternoon. We are so excited to have you here. We have Coleman Hundeby and Chris Clark. They are with Acra Lending, and they're here to share all of their knowledge with you, all things residential assisted living when it comes to financing that. And so I don't want to take up any more of the time that we have with these two. So I'm going to pass it along. Oh, I did want to give you guys a reminder. You can ask questions. There's a question bank or a question column, and just submit those questions. And at the end of the presentation, I will try to get through them as much as I can, and we can ask questions at that time, just to let everybody know. Okay, I'm going to pass it along.
Hello, everyone. Thank you for having us. My name is Chris Clark. I'm the Vice President here at Acra Lending, and joined by my colleague Coleman Hundeby. Coleman is also an account executive, top account executive in the industry, and a top account executive with Acra Lending. And we'll both be at the conference at the end of September. And following this discussion, we'll send you guys an email, with particulars on our products and kind of how to start the application process with us. Get through any questions that you may have, so you feel comfortable in moving forward with us. Together, Coleman and I, we have more than 40 years of experience in every loan product the banking industry has ever introduced. So from conventional loans to jumbo loans to private money, and now non-qualified mortgages, which if you turn on the news every once in a while, you'll see is gaining more and more steam. And I'll give you some reasons as to why. We've been heavily invested here in the non-qualified mortgage market with Acra Lending, which has been in business for more than 20 years. We're one of the top 3 lenders in our market, one of the few that offer products to the adult care industry. We're also one of the most well-capitalized lenders in the non-QM market. So very strong company, a company that's on the forefront of products and kind of changing the way the industry does business. Our products, although we allow tax returns, we're mainly geared towards not using tax returns to approve borrowers. And using tax returns are an imperfect method to understanding a borrower's ability to repay a loan. If you think about it, what does the IRS have to do with affordability, right? Other than how much can we afford to give the IRS? So there's an imperfect understanding in the marketplace on how to approve borrowers, and there's fundamental changes that are needed, which is why companies like us continue to thrive. Again, Acra's at the forefront of these fundamental changes in the marketplace. What we've been great at is making the traditional complex ways to approve borrowers into a simple approach to make it easier for borrowers like yourselves to qualify. And just a few examples here. We have borrowers that don't have any income, for example. We have borrowers that have multiple sources of income. We have borrowers with multiple LLCs, corporations, sole proprietorships, and borrowers that don't have any entity whatsoever. And just most recently, we closed an adult care facility home, single family home in Costa Mesa, California for $2.2 million. Okay, we had 3 different borrowers, 3 different LLCs, and even one borrower without any provable income whatsoever. So again, we take these complex situations and we make them easy for customers like yourselves. And we'll kind of go through just a few of the bullet points here on our product that relate directly to you all as you kind of, if you're not already into the adult care facility market or getting into it, it should pertain to everybody here. Jamie, can you pull up our flyer there if you don't mind? Okay.
Yeah.
And again, we could go on with this long PowerPoint presentations and all this stuff. The reality is it's not too difficult to do these loans. There's certain criteria like any loan that you have to meet, but we've really slimmed down the process and simplified it in a way that just about anybody can get into these properties, even people who don't own a primary residence already.
Give me one moment. I'm getting it up.
No
My
problem.
computer's
Take your time.
going slow.
So until she pulls that up, just to kind of tail off of what Chris said is, a lot of these properties that we're qualifying for rather than tax returns, we're utilizing bank statements. I'm sure he's going to go into that, but obviously those show cash flow, which we can utilize, or the on an appraisal. For those of you that have a multitude of properties, the rent survey as well. So again, our goal is to figure out what your situation is, because we service these loans. I think one of the big caveats is we've been around for 20 years as a lender and servicer. So Acra is not a broker. So we are holding these notes and servicing them. So we were able to obviously customize based off of different loan scenarios. Whereas for those of you folks historically that have gone to a broker, they're shopping with a multitude of people, seeing if it fits within that box. Our box is a little bit more malleable, being that we are servicing these things. So I think that one of the questions that I get is like, how can you guys do that with what happened in 2007 or whatever it may be? And like, how is it possible that you guys could do this loan? Well, because you need to show ability to repay. And again, I think one of the values of servicing loans is, we can make underwriting decisions that are, again, a little bit outside of the box. So I think that's one of the key differentiators in what it is that we do.
And again, one of the few lenders that actually lend on adult care single family properties. And there's so many ways for us to qualify borrowers, whether it's adult care, investment property, owner-occupied properties. So many products available and so many ways to be able to do it and structure it. The fact that we have the most products in non-qualified mortgages allows us to kind of take pieces, if not all, take pieces of these different areas to get you guys to qualify. And again, without using tax returns, tax returns are just again an incorrect way to view borrowers and their affordability. And that's again why we continue to grow, and this market continues to grow. And if you pick up mortgage magazines and stuff like that, or some of these business magazines, you'll see us on the forefront, and our CEO on a lot of the public or media going out today.
Sorry, I'm trying to get that flyer, but it's not letting me share my screen, so I'm working on it back here.
Well, you're muted, Coleman.
Oh yeah, Coleman, you're muted. I don't know if we can hear ya. Give us a second. Let's see if we can get Coleman's audio back up. I don't know if he can hear us. Coleman, can you hear us? We can't hear you, so I don't know if you want to unclick your mic and then click it back, maybe. Oh, I think we lost Chris. Or I mean Coleman. Oh, there he goes. Okay. Nope, still can't hear ya.
And we'll be available, everyone. Questions, whatever it is, at any time. We're not. Doesn't just have to be on this call here.
Okay, well, I guess while he is figuring out his audio, I have a couple questions, Chris, if do you want to do
Please.
some questions? Okay.
Yeah.
Just to kind of, okay, awesome. All right. Is there anything we should be seeing other than, oh, the presenter's face. Sorry, that's, no. Sarah, I have a handout and I'm trying to get it up on my computer, but if I can't, everybody's going to get the email of the handout as well. And then I have this question. Would they lend on a startup RAL that has no track record yet?
Without a doubt. We actually lend to people with no job, no business, no income. The way we would qualify you is based on the property, right? So a lot of lenders are going to, say you have to be doing this 2 years, 3 years. You have to have a track record of this income. Once the IRS has told you how to calculate your expenses, right? And we've all either have been or know people have been self-employed, or a lot of extra things that you write off that really don't identify the true income of the business, right? So you end up with a lower income than what you actually do have. So we have ways of approving you without income, without the job. The way we would structure a loan like that is we look at the property. Okay, the property is the ability to repay. So for example, if I'm purchasing a property, I'll use the Costa Mesa example, right? $2.2 million purchase. I think the loan amount was 1.6 or 1.7 in that range. Well, the market rents for that property, we'll look at the area as a whole and what's called a 1007 on the appraisal. So the appraiser would do their investigation, look at leases, rents in that area, and based on square footage, bathroom count, a lot of other things. But they'll come to a number, right, which would be the market rents. Okay, what we're trying to do is match the market rents with the principal, interest, taxes, and insurance payment of the subject property, the property you're purchasing. Okay, ideally, we want that property to cash flow is what we call it, or debt service. You'll hear that a lot on the commercial side of things and even more in the non-qualified mortgages. So we can take that rent amount or lease amount, right, average with other comparables, and derive a number from the property you're looking to purchase. Not all properties are going to be within that or going to cash flow or be even. So we do allow for properties that don't cash flow as well. And we'll go down 30% below what your principal, interest, taxes, and insurance amount are, right, on the 1007 or the rent amount. So even if it doesn't cash flow, we can still get you into that property. And again, it's the property, right, that's the ability to repay. And it seems kind of odd, right, when you think about it, right? How do you know if somebody's going to pay for this loan? Well, we've done tens and tens of thousands of these loans. Not only do we originate them, but we service them as well. So what becomes really important for us, since we have investors who purchase loans as well, they want to make sure people aren't defaulting on loans, right? So we set this criteria with the rents matching the PITI, or it can come in lower than what your principal, interest, tax, insurance payment are. And we know through tens of thousands of borrowers that these loans repay, right? Over and over again, they repay. And I've spent several years in servicing, managing portfolios for large institutions, smaller institutions, non-qualified mortgage institutions like us. And the reality is our default rate is at or below, in most cases, some of your larger lenders who stick with tax returns to be able to qualify you. So again, various ways. We even have assets you can use. We can deplete assets over a 60-month period. We don't ask you to liquidate anything, but another way of approving you, we can divide your total assets over 60 months, come up with a figure in order to qualify for that. If you do have a business, maybe you have another adult care facility that's running, we can even use those business bank statements or even personal bank statements if that's what you're using to qualify the loan as well. Sometimes that helps you get to a little better interest rate, a little higher loan to value, which helps you leverage more equity in the property, lets you keep more more money in the bank to get the business up and running, or even perhaps look at purchasing another facility. What we found is, there's just a huge need for this product. For one, you have the government who just lacks the infrastructure to be able to handle, the adult care needs, right? You have so many people that are in need of care. And to me, having a godfather and having my grandparents go through that process in some of these large outfits, it's not comfortable, and the reason I like dealing with the adult care is you have a smaller, a smaller venue, you have less clients, but you still have the backing of the government who's stroking these checks every month, right? Because that's one thing they are good with, is these checks are good and they will pay. But I think this industry brings the care value up compared to what the government's tried to provide. And there's a huge need with this, and it's going to go on and continue on. Even a generation behind me, not to say we'll all be here to see that, but there's 44% more people, right? Just in that generation. So you can imagine how this is trending. It's just getting bigger and bigger and bigger, and we're happy to be a part of it because, for one, it presents just better care for our family, right? Our uncles, aunts, cousins, mothers, grandparents, whatever it is. So we're happy to be a part of it. Can everybody see that?
Yeah, I was just about to ask, can you see that?
Okay, good.
I'm sorry, I was moving it around a bit, but I just want to make sure.
Yeah, so we'll just touch a little bit. This is kind of the typical, typical things we see on a loan. And again, there's so many variations of this product in our income streams that we can utilize to get you guys approved and fit into these quote unquote boxes. So again, no tax returns, right? I actually don't even allow them in the office. If they do come in, they'll come to me or Coleman, and we'll review them to make sure that there's nothing fishy in there or something we should be aware of. Because again, an imperfect understanding of how to approve a borrower. So we qualify in the cash flow, right? Do the market rents meet the principal, interest, taxes, and insurance? Right? That's what we're looking for, is the ability to repay. And if it doesn't, like I said, we'll go 30% below that mark, below the cash flow mark, to still get you guys approved. Right? So there are ways that we can get around and paint the picture correctly with our investor. And again, like Coleman said, our guidelines are just that. They're just guides, right? Most companies, these things are set in stone. We do loans all day long, and I look at loans all day long that don't quite fit the box. And we've been great at being able to summarize those, show the strength of the borrowers or the property, and continue to get those through approved and through the process to funding. Loan amounts up to $2 million. That's not set in stone either. We look at loans 5 million, 7 million, up to 10 million. I don't think we're going to have too many in the adult care area that are kind of going to get that high. But nonetheless, we do offer a loan amounts above the 2 million. Again, these are non-owner occupied properties, right? We understand you're going to be, starting a business there if you're not already taking over one. But these are investor products or business purpose products. And that's what kind of allows us to get outside of your typical financing requirements to get approved. We don't require reserves at 75% loan to value. And actually, that's actually our cap right now at 75% loan to value. So if you're using every dime you got to get into the property, you got enough money just to get the business going, get it up, the resources to carry it, and get you to a point where it's profitable. This will free up those funds to be able to do that. Some companies are going to ask for 12 months, depending on the property you're buying. That's a hefty chunk of change there. Again, no income, no job verification. We literally don't put anything on our application. It'll have your name, or if it's an entity that you're looking to close in, we'll review that to make sure it's legally enforceable, make sure you're on the right track for your entity information. But again, no income, no job. We offer everything from 5-year ARMs, 7-year ARMs, 30-year fixed, and probably our most popular product is a 40-year loan, right? And I get everybody gets 40-year loan. That's a long time, right? Well, you're running a business, right? How much can you reduce your overhead to create profitability, right? Which in turn gives you better care, gives you better recognition, positive recognition in the marketplace for people to want to bring their family to you for care. So the 40-year fixed product, the first 10 years, you can actually utilize an interest-only option, right? And depending on the loan amount, some of these have some pretty significant reductions in payment when you look at the interest only. And again, we're not here to push you into any one area. It's your decision to make. We're to show you that these options are available. If you're cash flowing, the business is just rocking, you may look for a shorter term, right, to pay down the note. And that's obviously an advantage for you too, depending on where you're at in the business endeavor. And again, reconciled rent estimates based on the 1007 or lease agreement. If you're buying new property, then we'll look at the 1007, we'll get market rents in the area. And this is all stuff that we'll address with you up front to make sure the property you're looking at is going to be worthwhile, right? What you don't want to be doing is your first endeavor buying a $3-4 million property. That's just never going to cash flow because now it's just a huge asset debt, right? You want to make sure the business is functioning, it's profitable, and then you look to buy similar type of properties that keep your expenses at a point where you can continue to leverage the market there. So again, that's just kind of a summary on what we typically see with these products. Again, we have other ways of using income to help you qualify bank statements, sometimes tax returns, assets. So a lot of ways that we can look at income or maybe income on other care facilities that you own, but many ways to fresh looks of how we can interpret what's actually happening and turn it into more or less fit within our guidelines to get you guys into the property. Coleman, anything you want to add there before we check the questions?
I apologize for my technical difficulties. I was able to hop on my phone here. I just think the overreaching point we're trying to make is we are the servicer of these loans, so we are able to a lot of these are story loans. They're not does it fit within the box? Is we look at perhaps you have other properties that are going to help with the cash flow of this, so we might take a little bit more risk in this property versus another one. So again, we're looking at a multitude of factors, and again, trying to get the full picture and story because we go down to I think 575 credit score on these things because let's face it, as entrepreneurs, as people that own their own businesses, I say all the time, bad things happen to good people all the time. Credit scores do not dictate fully the risk of a transaction. So while someone may have a lower credit score, we might be able to look at other situations to help reduce rate or increase loan to value. So again, that's where Chris and I come into play with obviously, with the fact that, I don't want to age myself, but, 25 plus years of experience. We've seen almost everything out there. And if we haven't seen it, the nice thing is Acra's been around for, as a servicer through Citadel for 20 years. So, we're able to take a look at these things and say, how can we make this work? So, Chris, I don't know if I want to see if anyone has any questions.
Yeah, just before that, bottom line is we have every solution you need to get into the market, stay in the market, so you can start and continue to be profitable. So we're here for all of those needs. And yeah, if we can start sharing, I guess, any questions that we have, that would be great.
Sorry, there we go. I was muted. Yeah, we have tons of questions coming in. All right, so let's see. Jacob asks, where can we reach if you want to apply? Where can we reach you if we want to apply for a loan?
Yeah, Coleman's going to be sending out an email following the discussion. Give him a few hours just to get it out, but he'll get an email out to you guys just with some basic program information and a way to start the application process with us or start the dialogue to asking any questions and going back and forth there.
Awesome. Yeah, and I'm also going to put in the chat at the end Coleman's contact information as well. All right, our next question is, can you put your contact, oh yeah, sorry. That was, can you put your contact information in the chat? Yes, we will, Sarah, or Lori. Okay, next one. Will you lend on sober living homes?
Yes, we do. Great question. We kind of treat them the same way exactly, actually, not kind of. We do. We're seeing those become more and more apparent in the industry. I have a friend that has 5 or 6 of them. So yes, we do, without a doubt.
And I want to make it clear too, we have a lot of folks that are experienced investors who have used sober home, ARF, RCFE, or whatever we want to label these things, properties where they do an appraisal. A lot of historically, brokers said, hey, take down all the pictures so that the appraiser doesn't know that it's a sober home, sober home living or RCFE, et cetera. We know, we're having this call because we lend on these properties. We don't have to hide the fact or mislead anyone that it's the standard single family residence versus sober home living. So just to be just completely transparent, we are lending on these properties as they are, not as a faux investment property or owner occupied SFR.
Great. Okay, the next one is, can you refinance a loan?
Yes, without a doubt. We can use current rents on the property. We can just use a 1007. Again, we can utilize bank statements if there's income derived from there. So we have other options as well. And again, we'll kind of pull these together and ask the questions up front to see which is best for you guys to get you through the refinance process. So without a doubt, especially right now, right? You have a lot of properties values coming down to some areas. So good time to capitalize on the market.
I think too, with a lot of these properties, they were obtained with, I see a lot of properties where they're obtained with hard money loans at 10, 11%. So, that's because a lot of these, a lot of RCFEs, et cetera, when they were bought initially, they had to be bought quickly. So they may have been acquired through hard money. So we're a great option to help, reduce, the interest rate and payment on those.
Awesome. Okay, the next one is this just for home, no upfront optional costs until home is filled? I don't know, I'm not sure what she means. So is this just for the home, no upfront costs?
The property does not, so let's say it's a 6-bed, it does not have to be occupied with tenants. So we would the rent survey, and this is maybe unnecessary, but the rent survey is a 1007 for an appraisal. Chris alluded to it earlier, but again, the property it could be the purchase of a new RCFE or ARF or sober home, and it could be sold down the road. So we would use fair market rents in the neighborhood to qualify, or bank statements. Perhaps you have another source of cash flow, but no, we do not need there to be any tenants or clients or whatever semantics we want to use.
And a majority that these are at purchase, right? They're vacant, and we understand that, which is why we rely on the 1007s and the community rents to as the ability to repay. So that's okay.
Okay. And then we have another one coming in asking, what are the interest rates?
Typically, rates right now, obviously, we're in an increasing rate environment. We're in the 6s to the 8s, depending on FICO, loan to value, in the product, right? If you want to go to a longer term product. A year ago, these were at 2.98%, 2.99%. So you'll start to see these come down a little bit as there's more liquidity in the market, and we're already starting to see that non-qualified mortgages are getting more aggressive on our side, more competitive when it comes to rates. And with us being the one of the top 3 lenders in the country in this space, we're able to make some maneuvering when it comes to interest rates. So in this market, not the ideal, right? Not the historic lows that we've all want. But again, we'll start trending. We're already seeing the trend downward with interest rates.
Yeah, I mean, I think one of the things to think about this is we all take pride in our interest rate, you know, in our primary residence. Like many of you, I have invested properties. I care about the interest rate, but what I really care about is that the cash flow. So a lot of these, like, okay, can we get into the property, qualify, and if rates go down in 6 months or 12 months or whatever it may be. So I feel the same way. Like, I love having a 2 in front of my interest rate, but a lot of these are, hey, how do we get you into the property, or put you in a better position if you had a hard money loan, et cetera. Yeah, we saw a rate decrease last week of 0.5%, which was absolutely the greatest thing in the world for us. So it was the first reduction that we had seen in months. So, hopefully we're trending in a positive direction.
Yeah, definitely. Okay, next one is, do you finance new constructions like from the ground up?
We don't do new construction right now. We do have a bridge product. We do have a fix and flip product. And that's actually a good thing you brought it up. So if you need somebody for ground up construction, we can kind of point you in the right direction. But another market demand right now is, and I'll give you an example, 40% of the properties in the US are underdeveloped. Right? These they look like my grandmother's property, right? Still has the same curtains, the same cupboards and stuff like that. So there's a lot of potential in these underdeveloped properties to be able to pick up with our bridge product, and also use the rehab loan that we offer as well to get the product up to par, right, with the market, and for your customers. So a good way to leverage where the market's at right now: short-term financing. You rehab the property, and then what we do is we take you into a long-term loan with something along these lines. Typically, once you rehab a property and you look to get long-term financing, lenders will make you wait up to a year, right? At least 6 months, sometimes a year or more, to use the new value of the property. Okay, if you're doing the bridge and the rehab loan with us, we don't require any seasoning at all. We'll just move you right into the long-term loan.
Awesome.
Very good question.
Yeah. Okay. Another question is, do you do partner buyout loans?
We do it all the time. So we see LLCs, you have a couple of partners on it. They want to reorganize their assets, more or less. We can do that. What we try and do is get ahead of what percentage the ownership is. With us, if you have 20% or more ownership in the property, we require you to be on the loan or personally guarantee the loan. But we can make, before we get into the process, we'll make some amendments with you, or request that you make some amendments to the LLC to reduce the percentage of the owner that's you're doing the takeout on, for example. But good question. Yes, we do. We just want to get ahead of it about 30 days before we start the application process. So that way it doesn't look like, hey, we're just changing a couple minor documents to reorganize for something else. So yes, we do that.
Great. Okay, this one's a little specific. It says, does your financing include construction improvements for like indoor sprinkler systems, safety requirements, along with the land and home purchase?
It would be a bridge loan if you are at that point. Really, you can do a refinance and take cash out of it. Sometimes that's not the best way to go. Depending on the size of the project, that you're working on. If it's sprinklers, something like that, something that's more on the minor side of the cost, I would probably look to my credit union, right? A small line of credit, something like that, to kind of just button up those areas. If it's something where you're adding square footage, a second story, some major improvements, then you would look to us for like a rehab loan. And then again, we'll move you into the long-term financing after that.
Great, awesome. All right, another one here. Can you use your loan? Oh wait, no, sorry, we just did that one. Who orders the appraisal and who owns the appraisal?
Actually, we would either ourselves through our retail division, or depending on the state area you're in, we may have a pass through a broker who orders it through an AMC. This day and age, everybody's tried to, since 2007, they've tried to create a huge space between the appraiser and the borrower and the lender, right? For obvious reasons, right? You don't want appraisers being swayed one way or another, which in turn affects the lender and default rates and things like that. So if you have an appraisal or you have an appraiser you want to use, what we would suggest is just letting us or the broker order it for you and maybe request that appraiser. So it's not so direct and it doesn't come up in our review process and underwriting. So there are ways, I guess the answer, there are ways we can get around it, but there's a certain path we want to go through to do it.
Great. All right, another one coming in. Is 90% of the financing available, or is 90% financing available?
Not on investor loans. The only way you may see that would be on your traditional lending side, right? Like walking into a Bank of America, showing tax returns, something of that nature. Typically, our loans, especially if they're adult care specific, would be at 75%. If you're just purchasing it, for example, and maybe it is an adult care, maybe it's not going to be an adult care, we can even go as high as 80%, right? So there are ways we can kind of get around that 75% max, but traditionally you won't see anybody in our side of the market getting to a 90%, and as they shouldn't. The risk becomes much greater at that point. There's less skin in the game from the borrower, which means there's less reason to try to hold on to that asset. And we've seen in the past that default rates tend to increase significantly once you start going over that 80% mark.
All right, and this one is, can you use your loan to refinance and take cash out to pay me back for a startup investment?
Without a doubt. You can take cash out, replenish the costs or whatever you've spent to get the business up and running. We even do that with people who just pay cash for properties, right? We get hard money people, or people just said, look, I had to have this property. I bought it right now, wired the money, right? And now they're like, okay, where will I get my, $500,000 back? They come right to us, and we'll actually treat it as a rate and term refinance loan and replenish the cash that you used to purchase the property. You want to try and do it within 120 days of the time that you purchase the property, because that'll keep us in the delayed financing paradigm and be able to replenish all of the cash that you spent in acquiring the property.
Great. All righty. Got tons of them coming in, so I'm trying to get to all of them here. This one asks, do you offer a credit line?
We don't offer lines of credit. Currently, that market is really poor. When I say really poor, you have kind of a downswing in values in many areas. So the risk of line of credits currently is very high. If you're looking for line of credit, small amounts, again, I would probably lean towards my credit union, somebody like that, maybe a regional bank that you have a relationship, even like USAA credit union. You can, I think you get $60 donation to Wounded Warriors or something, and you can get, an account with them and maybe look at those. But yeah, that's not a good market for those currently, unfortunately.
Okay, good to know. All right, next one is, what is the average equity injections for your loans?
Typically 20 to 25%. That's what we're looking for. That's what the market will bear. That's what keeps default rates low enough to be able to continue to offer these products. And that's regardless if you're in your traditional lending or on the which is qualified mortgages, or on the non-qualified mortgages on our side. Default rates increase significantly on investment properties once you start getting over 80% or even 85%.
Great. Okay, we'll do a couple more here. Can you roll some working capital into the total loan?
When you say roll it into the total loan, if it's costs or something that you've accumulated or need to pay for, without a doubt. You can do it two ways. We can either include it as a payoff, or we can just give you the cash for it. If it's a huge payment or something, maybe a line of credit or something you took out, then we'd want to pay it off because that's going to reduce your total overhead as far as how we're looking at the loan. But good question. But yeah, we'll look at the different ways what's best for you. As long as the property's at that cash flow point, then we'll probably just give you the cash back. If it's not or it's close, then maybe we'll look to pay it off. Just to keep the property cash flow.
Awesome. Okay. Does this loan product appear on your credit report?
Yes, it does. It will appear. You will personally guarantee the loan, so it will appear on the credit report. You can close in a corporation, LLC, or what have you, but we still require a personal guarantor by anybody who's 20% or more ownership of that entity.
Great. Okay. Do you work with SBA loans or have any experience with those?
I've tried to work with them in the past. From my understanding, once you get into SBA, you get into government red tape, more or less, right? Businesses have to meet certain capital requirements, certain profitability. The property really isn't taken into consideration. And what they're looking for is where can they leverage what they're loaning you on any and all of your assets. So you may do a takeout on a loan on, say, one of the adult care properties, and they may want to leverage your primary residence, right, with another lien. So now you start cross-collateralizing liens on your investments and your properties, even your primary residence. And that's what typically scares me a little bit about those. I won't say they're bad in any way, but that's been my experience. If you are the golden goose, maybe you get a little better rate or something like that. But for the most part, it's more arduous since it is a government program.
Yeah, and to kind of like trail off what you were saying is SBA loans are very functional in certain, for certain reasons. If you've gone through the SBA process, application process, it's not overnight. I'm trying to be as kind as I can through that process. With us, we're looking at a 30-day process on the purchase or refinance, and an SBA loan, 90, 120 days. Maybe someone's had better experience than that, but in reality, a lot of these properties that purchased, a lot of sellers aren't willing to wait 120 days. So they might want to go into, that's why we do a lot of takeout loans from hard money, because a lot of these properties, they wanted to sell quickly, right? Because they're cash flowing. So we do a lot of refinances from hard money into this product. But an SBA loan, again, it's generally a much longer process, so that's one of the challenges with those.
Awesome, thank you. Okay, again, gotten a couple more in. Can you do construction loans?
We'll do rehab loans.
Okay.
So if underdeveloped property, right, you want to add new cupboards, flooring, roof, whatever it is, right, appliances, all the stuff that actually will increase value in a property, those are the loans we will do. We won't do ground up construction.
Okay,
and they're starting to get more and more popular now, but not quite yet. Probably by the end of the year, we'll be able to do ground up construction.
Okay, awesome. Yeah, I have a lot of questions about that or renovation, but it sounds like not from ground up. Okay. All right. Is there a cap on the number of these loans a borrower can sign for?
We typically will cap a borrower at four loans. They can have as many loans as they want elsewhere. But as far as the ones that are with us, we'll keep it to 3 or 4. And then once those properties move out to our servicing and then get sold, then we can open up to do another 3 or 4. So there may be a little bit of time there in between in order to do that. On a side note, we do offer blanket loans for investors. These aren't particular to adult care. But if you do have a bunch of properties that you own, maybe they're just rented out as normal, we'll do a blanket loan. So what you'll cross collateralize the equity in these properties. And you, instead of having 9 different servicers and taxes and insurance and where is my servicing transferring to? Why don't I have their phone number? What's my new loan number? Hiring a bookkeeper to keep track of all this stuff. You can bring all of those loans into one note, make one payment, and that'll simplify the process for you and reduce your costs to just manage the properties.
Awesome. All right, we'll do one last one here. How long does it take to close after the appraisal is reviewed?
It's really not a long process. Usually the appraisal is what takes the longest, depending on the market demand. Right now we're getting appraisals back in 2, maybe 3 weeks at the most. As long as you're on the phone, yes, I can be there at the first available appointment. We can usually get these done anywhere from 2 to 4 weeks.
Awesome. Okay, I think I got to everybody's questions. So I am going to put Coleman's contact information in the chat. It's right there for you guys. I'm also going to send a recording of this webinar to everybody as well if you want to go back to it, rewatch it for reference, as well as the handout that I shared for most of the presentation today. Thank you for your questions. Chris, Coleman, do you have any final words for everybody? Want to share anything else?
I look for, if any of you are joining the conference end of September, beginning of October, look forward to purchasing a nice tea or a nice cold beverage with you or whatever you wish. It's, for me, and similar to Chris, being in lending since 1996, our industry sometimes has had ups and downs, but I'm proud. It makes me feel good when I can tell people that they say, "What do you do?" I focus and lend on RCSEs and ARF properties. It's to me, it's a feel-good thing. We're certainly helping you as a business owner, and I really think the elderly. I don't know, maybe I'm corny, but it makes me feel good. I love the fact that Acra can work with you guys to try to find ways to make this happen. So, thank you. Look forward to helping you out where I can. Chris?
Yeah, thank you, everyone. Pleasure being involved, especially something like this with the adult care. I think it hits, it gets to the heart, right, with all of us at some point in time. And again, it's a feel-good thing for us. And I know you guys don't know Coleman and I at all, but these are the type of people we hire. This is what we represent. And we're not these executives that just wear blue coats and sit in corner offices. We're out there, we talk to you, we're just people, right? And we know there's a need there, so we just want to be able to help you guys as best as we can. And then you'll see me as well at the event end of September also. So pleasure, thank you for having us, and we're glad we're able to be a part of this.
Oh my gosh, that's awesome. Thank you guys so much for taking time out of your day to do this webinar. It was super informative, very helpful. I'm going to be at the convention as well, so hope to see you all there and we can network and meet in person. Who wouldn't want to work with these guys? I'm excited for y'all. So thanks for joining us this afternoon, and we'll see you on the next one. Bye, everybody.
Thanks, everyone.